Your business can be profitable, sales can be growing, and money can still feel tight. Even worse, the bank can suddenly stop supporting you. This is where most beginners get confused. They think profit is everything, but banks think differently. Banks care about financial covenants. In this video, you will learn financial covenants with real, practical business examples. Now, let us understand financial covenants using one simple, real-life business example. Imagine a small manufacturing business in the United States that produces custom packaging boxes for food brands. The owner is running the business smoothly and decides to take a bank loan to expand operations. The bank approves a loan of $500,000. Along with the loan, the bank includes financial covenants in the loan agreement. These covenants are not suggestions, they are strict financial rules the business must follow every year. The first covenant is debt-to-equity ratio. At the time of loan approval, the business has total debt of $500,000 and owner's equity of $250,000. This makes the debt-to-equity ratio 2:1. The bank clearly mentions that this ratio must not go above 2.0. This rule exists to ensure the owner is not running the business entirely on borrowed money. In the first year, the owner takes another small loan of $100,000 without increasing equity. Now, total debt becomes $600,000, while equity remains the same. The new ratio becomes 2.4, which breaks the covenant. Even though sales are growing, the bank now sees higher risk. The second covenant is debt service coverage ratio, commonly called DSCR. This covenant checks whether the business generates enough cash to pay loan installments comfortably. In our example, the business generates annual operating cash flow of $120,000. The total yearly loan repayment, including principal and interest, is $100,000. This gives a DSCR of 1.2. However, the bank's requirement is a minimum DSCR of 1.3. This means the business is cutting it too close. Any small drop in cash flow could cause payment issues. Even though the owner shows profit on paper, the bank focuses on actual cash availability. The third covenant is the current ratio, which measures short-term financial strength. The bank wants the business to maintain a current ratio of at least 1.5. Initially, the business has current assets worth $300,000 and current liabilities of $200,000, resulting in a healthy ratio of 1.5. Over time, the owner stocks up inventory worth $100,000, but sales slow down and receivables take longer to collect. Meanwhile, short-term payables increase. Current assets drop in usable cash, while liabilities rise. The ratio falls to 1.2, breaking another covenant. The fourth covenant is interest coverage ratio. This checks whether operating profit can comfortably cover interest payments. In the beginning, operating profit is $80,000, and annual interest expense is $30,000. The ratio stands at 2.6, which is acceptable because the bank requires a minimum of 2.5. But later, interest rates rise and profits dip slightly. Interest cost increases to $35,000, while operating profit drops to $70,000. The ratio falls below the requirement. Again, the business is profitable, but covenant compliance fails. Here is the key learning. Financial covenants do not care about emotions, effort, or future promises. They only care about current numbers. When one or more covenants are breached, the bank may issue a warning, restrict further borrowing, demand corrective action, or even revise loan terms. This is why many beginners feel shocked when banks suddenly act strict. The mistake is assuming profit equals safety. In reality, covenant compliance equals trust. Once a financial covenant is breached, the bank reaction usually surprises beginners. The bank does not immediately shut down the business, but it also does not ignore the situation. In most cases, the bank sends a formal notice called a covenant breach letter. This letter states that one or more financial conditions mentioned in the loan agreement are no longer being met. From this moment, the power balance shifts slightly in favor of the bank. Let us continue with the same packaging manufacturing business example. The business is still making sales, employees are being paid, and profit exists on the income statement. However, because the debt service coverage ratio has fallen below the required level, the bank now considers the loan to be at higher risk. The bank may first ask for updated financial statements, cash flow projections, and explanations. This is not punishment, it is risk control. If the numbers do not improve, the bank can take several actions. It may restrict additional borrowing, which means the business cannot take new loans or increase credit limits. In some cases, the bank may increase the interest rate to compensate for higher risk. This immediately increases interest expense and puts more pressure on cash flow. In serious situations, the bank can demand partial loan repayment or restructure the loan terms. This is rare but possible when multiple covenants are breached at the same time. The most important lesson for beginners is this: financial covenants are not checked only at the time of loan approval. They are monitored regularly, often every quarter or every year. Many business owners look only at profit and loss statements and ignore cash flow and balance sheet numbers. This creates blind spots. Covenant issues usually start quietly and become visible only when the bank points them out. To stay safe, beginners should track 4 key areas regularly. First, monitor cash flow, not just profit. Profit can exist without cash, but loan payments require real cash. Second, avoid taking new debt without checking how it affects debt to equity and debt service coverage ratios. Third, manage working capital carefully by controlling inventory, receivables, and payables. Poor working capital management is one of the biggest reasons covenants fail. Fourth, review loan agreements carefully and understand the exact numbers the bank expects you to maintain. The smartest business owners treat financial covenants as early warning signals, not threats. When monitored properly, covenants help maintain discipline and financial stability. They push businesses to grow responsibly instead of growing blindly. For beginners, understanding covenants early can prevent panic, protect banking relationships, and keep long-term growth smooth and predictable. This is why financial covenants are not advanced finance concepts. They are basic survival tools every serious business owner must understand.